Imagine a single trade, barely $280 million worth, ripping through Japan's $7.2 trillion government bond market like a spark in a powder magazine, erasing $41 billion in value in hours. Screens froze on trading floors from Tokyo to New York as yields on the longest bonds exploded upward, shattering records that had stood for decades. Hedge funds scrambled to cover positions they never thought could unravel so fast. Life insurers watched portfolios hemorrhage, and in the quiet panic of that Tuesday afternoon, the world glimpsed something terrifying. The illusion of stability in the planet's second-largest debt market had just cracked wide open. What started as routine trading turned into chaos because there were simply no buyers left at the old prices. The market that once absorbed endless government borrowing without flinching suddenly refused to cooperate. And the question hanging over every investor now is whether this was a freak event or the first tremor of something far larger, something that could drag global borrowing costs higher, squeeze liquidity everywhere, and force central banks into choices no one wants to make. Stay with me, because the full story of how a tiny trade detonated such massive destruction reveals cracks that run straight through the heart of the global financial system. It began quietly enough in the pre-dawn hours Tokyo time. Traders were watching the 20-year Japanese government bond auction, a routine sale of debt that usually draws steady demand from domestic institutions. But this time, the bids came in weak, demand barely above the 12-month average, signaling reluctance. Yields ticked up modestly at first, nothing alarming. Then the secondary market opened, and the selling pressure that had been building for weeks found its moment. Super long bonds, the 30-year and especially the 40-year, began sliding. Prices fell, yields rose in lockstep, and the move accelerated with terrifying speed. By midday, the 40-year yield had blasted past 4% for the first time since these bonds were created in 2007, a level unseen on any Japanese sovereign maturity in over 30 years. The 30-year jumped more than 25 basis points in a single session, the sharpest daily move since global markets convulsed under tariff shocks the previous year. Turnover across ultra-long maturities, just $280 million combined. That was all it took to trigger the $41 billion wipeout across the curve. In a market that size, such thin volume should have been absorbed without drama. Instead, it exposed how fragile liquidity had become. The buyer's strike was unmistakable. Domestic institutions, pension funds, insurers, banks hesitated. Foreign participants, who now dominate much of the cash trading in JGBs, pulled back even harder. For years, Japan's bond market had been the calmest corner of global finance, propped up by the Bank of Japan's massive purchases and decades of near-zero rates. But the BOJ has been quietly stepping away, reducing its footprint as part of a gradual normalization. Quantitative tightening has shrunk its balance sheet, leaving more bonds in private hands. At the same time, inflation has refused to fade, forcing a rethink of what safe really means for long-duration debt. Investors who once accepted microscopic yields to hold Japanese paper now demand a real premium for the risk that prices could fall further if fiscal policy loosens. And fiscal policy is exactly what lit the fuse. Prime Minister Sanae Takaichi's decision to call snap elections for early February came with bold promises. Slash the consumption tax on food from 8% to 0%, deliver stimulus worth trillions of yen, and keep spending high to fight cost of living pressures. On paper, these pledges sound voter-friendly in an economy still recovering from stagnation. But Japan already carries the heaviest debt burden in the developed world, well over 250% of GDP. Every new yen borrowed adds to a mountain that servicing costs could soon overwhelm. Higher yields compound the problem exponentially. At 4% on the longest maturities, interest payments on new issuance would devour a growing share of tax revenue. The math is brutal. Even modest rate increases turn sustainable debt into an accelerating crisis. Bond vigilantes, dormant for decades in Japan, are waking up. They are pricing in the possibility that political populism will outrun fiscal discipline, and they are demanding compensation before they lend again. The immediate fallout was visceral. Trading desks reported chaos, orders unmatched, spreads widening to levels not seen in years. Hedge funds holding leveraged bets on stable yields rushed to unwind, amplifying the move. Life insurers, mandated to hold long-duration assets to match liabilities, faced mark-to-market losses that forced selective selling just to maintain solvency buffers. One corporate bond deal reportedly collapsed mid-negotiation, as confidence evaporated. Globally, the ripples arrived almost instantly. U.S. Treasury yields climbed in sympathy, with long-end rates touching multi-month highs as investors recalibrated the cost of safe assets worldwide. European bonds followed suit. Equity markets dipped as risk appetite contracted. Even gold, the classic refuge, saw renewed buying as fears of broader instability mounted. The transmission was clear. When the bedrock of yen-denominated safety fractures, confidence in fixed income everywhere takes a hit. But here is where the story turns darker, where earlier assumptions start to unravel. Many observers initially frame this as a localized Japanese event. Political noise ahead of an election, a temporary dislocation in a market still dominated by the central bank. Yet the liquidity gauge for JGBs hit record extremes during the rout, signaling not just a bad day, but a structural shift. The JGB Liquidity Index, which tracks how far yields deviate from what ample trading would imply, spiked to unprecedented territory. Buyers were not merely waiting on the sidelines, they were absent. And the absence was not random. It reflected a deeper repricing of risk that has been building since the BOJ began tapering support. For 30 years, the market operated under an unspoken guarantee. The central bank would cap volatility, pin yields, and absorb excess supply. That guarantee is eroding. The BOJ cannot reverse course without reigniting inflation it has fought to create. Nor can it ignore the political pressure to let markets set prices more freely. Caught between those poles, policymakers are watching the market test its own limits, and finding those limits closer than anyone expected. Midway through this unfolding drama, a contradiction emerges that forces a complete rethink. The very policies meant to stimulate growth, tax cuts, higher spending, are the ones accelerating the bond sell-off. Takaichi's platform aims to ease the burden on households battered by inflation. Yet the bond market interprets those promises as fiscal recklessness that will require even more borrowing at higher costs. The stimulus becomes self-defeating. Cheaper food today, but exploding debt service tomorrow. This is the uncomfortable truth staring down Tokyo's policymakers and investors alike. Japan cannot afford higher rates, yet the market is forcing them anyway. Every basis point rise in super long yields adds billions to future interest obligations. At current trajectories, the government could soon face a scenario where interest payments consume a larger slice of the budget than defense or social welfare. Politicians will resist austerity, but markets do not negotiate. The standoff is classic bond vigilante territory. Investors refusing to finance deficits they deem unsustainable until yields compensate for the danger. And in Japan, where the debt stock is so enormous, even small yield increases deliver outsized pain. The global implications compound the urgency. Japan remains a major creditor nation, with institutions holding vast foreign assets accumulated during decades of low domestic returns. As yields at home become genuinely attractive, 4% in yen, without currency risk, repatriation pressures build. Funds that once flowed into U.S. treasuries, European debt, and global equities may turn inward. That reversal could tighten liquidity abroad, push foreign yields higher, and complicate the Federal Reserve's path if it needs to ease. Carry trades built on cheap yen funding face renewed threat. As Japanese rates climb, borrowing costs rise, forcing leverage positions to unwind. The feedback loop is vicious. Higher yields beget selling, beget thinner liquidity, beget even higher yields. What looked like a contained episode in Tokyo begins to look like the opening act of a broader repricing of sovereign risk across advanced economies. As the session drew to a close that Tuesday, some stabilization appeared. Yields eased slightly from intraday peaks, hinting that opportunistic buyers had stepped in at extreme levels. Banks signaled readiness to rebuild holdings once volatility subsided. Yet the damage was done. The $41 billion wipeout from such minuscule turnover laid bare how exposed the market remains to sudden shifts in sentiment. Thin liquidity is no longer an occasional glitch. It is the new baseline in a world where central banks retreat and fiscal demands grow. The 40-year yield touching 4% is not just a number. It is a warning that the era of effortless borrowing may be ending, not just for Japan, but for any nation reliant on investor confidence to fund chronic deficits. In the aftermath, the question is no longer whether Japan can muddle through with ultra-low rates forever. It is how quickly and painfully the adjustment will unfold. If the election delivers more spending promises without credible offsets, the bond market will keep pushing back. If policymakers tighten fiscal policy to appease investors, growth could stall, reviving deflationary ghosts. Either path carries risks that ripple far beyond Japan's shores. Global investors now watch every auction, every yield tick, every political statement with heightened scrutiny. The thin trade that triggered catastrophe was not an anomaly. It was a stress test the system barely passed. And the next one may not be so forgiving. This is the reality we face. A world where sovereign debt markets, long taken for granted as safe harbors, can fracture under pressures that once seemed containable. The $280 million spark revealed $41 billion in vulnerability, and countless trillions more hanging in the balance. For anyone with exposure to bonds, equities, currencies, or simply the cost of living tied to borrowing rates, the lesson is stark. Stability can vanish faster than anyone imagines when faith in the issuer falters. Japan is not collapsing tomorrow, but the cracks are visible, spreading, and impossible to ignore. The meltdown was a glimpse of what happens when the market finally says no. And once it says no, getting it to say yes again comes at a very high price.